this is the part of this curriculum that I've been waiting for, where we're going to talk about capital structure. So we've discussed a lot. We've talked about DSCR, we've talked about working capital, we've talked about what docs are needed for each product, we've talked about the processing for each of those products, what that process is like. So whether you're going to be working with us or not, you guys will be prepared to go out and tackle raising any financing for your projects out in the world of real estate. But this next curriculum is really going to tie everything together, and I think it's going to be the most important for you guys. This one is basically going to talk about how companies use debt and equity or hybrid securities to finance themselves. And we're going to talk about the cost of capital, we're going to talk about different forms of risk in capital structure, and we're going to talk about value, and we're going to talk about tools to optimize financing decisions. So I thought about for a long time how I could start a conversation and frame it properly if we're going to talk about capital structure, because it is a little bit of an advanced topic. So I think the best place to start is, what is capital? And basically the essence of capital at its core is that it's stored potential. Okay, it's not money. It's any form of wealth, resource, or asset that can be deployed to generate more value. Elon Musk likes to say that capital is just a form of information to determine how to allocate labor. Whereas unlike consumption, something is used up, capital implies the possibility of growth, reproduction, or leverage. And there's different types of capital. There's financial capital, money, credit, investments, liquid instruments. There's physical capital as well, tools, machines. There's human capital, which is not reflected on a company's balance sheet. There's social capital, which is just a relationship, maybe a network of people that you have, trust or goodwill that you have built up with close associates. There's natural capital, that's land, water, raw materials, minerals. And then there's intellectual capital, that's an idea, maybe a brand, a patent, etc. Our conversation is going to be focused on financial capital, more specifically debt and equity, the two forms of financial capital. This distinction is pretty important because all forms of finance are going to ultimately fall into two buckets, that's debt and equity. And they're not just funding mechanisms, they both represent two fundamentally different relationships to risk, return, and control. Understanding the difference between debt and equity sets the stage for grasping capital structure and eventually the capital stack. This is going to be very important before we move on. Understanding the difference between debt and equity is going to frame what a capital stack is in the proper way. So starting off with equity, there's an analogy that I put in here for equity and for debt. The analogy for equity is going to be venture capital. So venture capital investing is a form of equity financing where they finance risky projects, but they can capture ridiculous upsides. But they can lose everything. So they're putting their money into something that could go to zero, but if it doesn't go to zero in some cases, then they're going to get outsized returns. Equity holders usually own decision-making power, they have a really high risk tolerance, more than debt, and their return profile is variable, it's not fixed. We're going to see with debt that a lot of debt instruments have a fixed return profile. A lot of forms of debt, even across the capital stack, are going to have different interest rates. Those are fixed, whereas equity is unfixed and it's uncapped. That's important to know. Equity capital is just money that's provided in exchange for ownership of an enterprise or of a company. So again, this analogy for working capital is going to be the perfect one to drill it home, where venture capital investing is a form of equity financing where they finance risky projects, they take a stake in a company, they get board rights, they get decision-making power, it's high risk, they have variable return, and it's money provided in exchange for ownership of an enterprise. That's going to be completely different from debt, where the definition is going to be money loaned with a contractual promise to be repaid, typically with interest. All forms of debt are effectively a contract where I'm lending you maybe $100 and you're going to pay me back a certain percentage, so it's fixed. It's not variable, it's not like equity, it's fixed. Debt holders receive scheduled payments regardless of a company's performance, and the risk profile is completely the opposite of equities. Whereas equity is very risky, debt is seen as being very safe. So our analogy in this case is going to be banks. Banks are the perfect analogy for debt capital, and they pretty much represent debt financing. They don't take on any risky projects. They capture predictable yield across interest rate environments. They have very little direct ownership, if any, but they have strong influence via covenants, via liens, that's collateral rights, and then repayment priority, right? If you think about a bankruptcy, usually any lien holders, first lien position holders, are going to be first in line to be repaid in the event of a bankruptcy. That's why debt capital is seen as not being risky, whereas equity capital is seen as the opposite. Whereas equity is completely variable, debt is fixed, you know what you're going to get. Equity capital is this one. Equity capital is risky. Debt is not risky because in the event of a bankruptcy, equity loses everything, and debt has usually a lien to have any claims on remaining assets. And here's the trade-off, right? Equity is going to be high risk and growth potential. They absorb risk, they attract long-term investors, and they dilute ownership. Whereas debt is going to be low risk, predictable. It provides predictable financing. It's cheaper than equity, but it introduces repayment obligations, and it can sometimes make a company's finances fragile. No company, for the most part, relies on one. Debt and equity are combined into this concept called capital structure, which is just the blueprint of how the financing for a company, or, as we'll see, a real estate project, are arranged. Within that blueprint sits the capital stack, which is a hierarchy of claims about who gets paid first, who takes what, and who takes the most risk. So we have this concept of debt, we have this concept of equity. They stack together to make this thing called a capital stack, which leads us to our next point, understanding capital structure. So if debt and equity capital are just the fuel for the engine, capital structure is the design of the engine. How is that fuel spent? Is it being spent efficiently? Can this be optimized? How can we mix these different fuels together of debt and equity to power the enterprise? Capital structure matters, as you see, because it introduces this concept of the cost of capital. Whereas debt is usually cheaper but riskier in higher doses, equity is safer but more expensive. Debt preserves ownership while equity dilutes it. A leverage structure magnifies gains and losses. An equity-heavy structure is more shock-resistant but less aggressive. You get less upside potential. And so where is going to be that perfect balance? How can you mix these different ingredients together to optimize a capital structure? That's where this concept of capital stack comes in. So these are really the different forms of capital that are important to know. So we have the different forms of equity, the different forms of debt. Here at the top are going to be your asset-based loans. This is most of the time where your mortgages are going to sit. Asset-based loans have a first lien position. They're going to be senior secured debt. Slightly below that senior debt is going to be junior debt or subordinate debt. Usually with subordinate liens, a higher rate. So your senior secured debt is going to have the lowest interest rate, highest priority, strongest lien. Junior debt is going to have a subordinate lien with a higher interest rate. Mezzanine debt is going to have an even higher rate, typically with no liens. And then preferred equity is a form of a hybrid security where you get some equity participation, but you also get a fixed coupon. So it's like a mix of debt and equity. You don't need to know that for the sake of this discussion. And then common equity is basically going to be your full upside potential. Doesn't pay any fixed rate, but you get the full participation for whenever you sell. So as we go down the capital stack, you have your highest, or I guess your lowest risk form of capital here. So this one always has the strongest lien. This one has no lien. This one is the cheapest interest rate. So as we go down, this is a higher interest rate. This one is an even higher interest rate, and then becomes equity. So then this one doesn't have any interest rate, but it dilutes ownership, and then this one dilutes ownership even more. So as we get lower down the capital stack, we'll see that it becomes more expensive. There's really two lenses that you can analyze a capital stack through. You can look at it from a business owner standpoint or an operator standpoint, or you can look at it from a banker standpoint or a financier's perspective. To a banker, a capital stack is just going to be a menu of different forms of capital, right? Risk trade-offs. Why would I want to finance a project with equity if maybe this project is riskier? I would rather finance it using debt. And so it's like a menu of a risk-return trade-off. Now, if we view it from the other perspective, or the operator, business owner perspective, this is going to be the capital user. So debt is actually going to look like the most expensive in some cases, right? Unless we're talking about ownership dilution, then that's going to be a different perspective. A lot of the times, to a business owner who's raising money, debt can be attractive because it preserves ownership. It doesn't dilute your portion of the profits or any revenue shared, but it's dangerous because it locks in fixed obligations. If cash flow stumbles, you still have to meet those debt payments. Debt is most of the times better for stable cash flowing businesses like real estate, utilities, or more mature companies, and then equity is going to be better for your typical tech companies, things that are not going to have stable cash flows but are going to have high growth potential. So equity provides some flexibility. There's no mandatory repayments, but it's costly because it dilutes ownership and control. So just to frame that contrast there, the financier will basically look at the capital stack from the top down and say, how safe is my money? How much am I going to be getting back? And then the operator, the business owner, is going to look at the capital stack from the bottom up because he has equity, and is going to think, how flexible or how much flexibility do I gain and what control do I lose? So capital allocator or a banker or a financier is going to think about risk-adjusted returns, whereas an operator or a business owner is going to think about cash flow, fragility, and control, profit share, ownership, etc. So the question everybody here is wondering, I'm sure, why does this matter? So this is important because understanding the relationship between debt and equity and the capital stack allows us to frame a discussion of the cost of capital, where every dollar you raise carries a price and a set of terms. Mastering those prices and terms is how you can build capital stacks that A, get deals done, and B, maximize risk-adjusted returns, but more importantly, gets you mind-boggling cash-on-cash returns. So we discussed this whenever we were talking about the capital stack itself, but this is effectively the cost of capital ladder. So senior debt with first lien position note is going to be the cheapest form of money for you as a business owner because you're going to have your lowest interest rate. Then as you go down the capital stack, you're going to have a higher interest rate, and then eventually it's going to dip into ownership dilution, which is going to be the most expensive. And costs differ for a variety of reasons about priority of liens, volatility of cash flows, control over decision making in that enterprise is also going to be a form of a cost. So now that we understand capital structure, differences between debt and equity, we can think about the cost of capital and the weighted average cost of capital, and how we can structure capital to blend prices, lower your average weighted cost of capital so you can get a higher cash-on-cash return. That's basically what the weighted average cost of capital is. It's going to have a fancy equation like DSCR and these other things, but really it's just the combination of the different forms of capital that you're arranging to finance a project. You can lower your average cost of capital by anchoring your capital stack with as much senior debt as possible. Again, that's the cheapest form of money. It's going to have your lowest interest rate. And the more senior debt you can stack onto a transaction's purchase price, the more comfortably that transaction is going to be able to service that debt. So in terms of engineering capital stacks, we want to start with senior debt, layer on as much senior debt as possible because it's going to be the cheapest. We want to backfill that with as much subordinate debt or mezzanine debt as possible. Not too much, right? We want the majority of it to be senior debt because it's going to have a lower interest rate. But then we can put in that mezzanine debt or senior or subordinate junior debt. Even though it has a higher interest rate, we can bridge that gap. The less equity capital we can put into a transaction, the higher our return profile is going to be. So there's an art and a science to this. You want to have sufficient coverage of your debt, right? Going back to that concept of DSCR, you want to have enough coverage of your debt so that it's positive. You always want a positive DSCR. Anytime your DSCR drops below a 1, that's going to be your trigger to stop backfilling it with junior debt. Maybe you need less junior debt, you need more equity because your DSCR needs to be positive for you to cash flow. And this is basically the reason why you would want to have as much debt in a transaction as possible. Debt, put simply, is going to amplify your equity returns. So here's going to be a really simple example. If we're buying a company or we're buying a piece of real estate and it costs $10 million, but it produces $1 million in net operating income or EBITDA, we're going to run two different projections here. So in case A, which is going to be only senior debt, the cheapest form of capital, we're going to borrow $6 million. It's going to be 60% LTV effectively. That $6 million is going to have a 7% interest rate. It's going to have a note of every year $420,000. So you have $1 million in EBITDA or net operating income, that cash flow is going to service the $420,000 interest note every year. That's going to leave you with $580,000 of free cash flow, and your return on equity is going to be 14.5%. Whereas in the next projection, we're going to have $6 million of senior debt, same case as projection A at the same interest rate, 7%. That cost is going to be $420,000, but we're going to add another $2 million of mezzanine debt, so we're going to go up to 80% LTV. That $2 million of mezzanine debt is going to have a 12% interest rate, so your total yearly cost for all of that debt is going to be $660,000. That's $240,000 more than case A, and you're going to have a lower equity payment, so you're going to be at 80% LTV. You're going to be putting 20% down on this, so $2 million. Your free cash flow after all expenses is going to be $340,000, so you make less money nominally, but you have a higher return on equity. That's why debt is used in transactions. That's why leveraged buyouts exist in the first place, because they allow you to get a higher cash-on-cash return. This case illustrates return on equity, but in real estate, you can translate return on equity to just being cash-on-cash. So again, just putting it together here, financier versus operator logic, banker versus business owner. Bankers are going to price by the downside first. They're going to always assume something is going to go bankrupt. They climb down the capital stack. So they look at the top portion of it. They start at the top and they say, what's going to be the protection on my money? What's going to be my yield? They don't want to lose money. Whereas the business owner, the operator, wants to make money. They start at the equity portion of the capital stack. They look up and say, how much flexibility can I buy with each dollar as each dollar gets more expensive, and how much dilution or control do I give up? So the best capital stack is going to be somewhere in the middle between satisfying both what the business owner wants and what the banker wants. That's what a capital market is. Now, in terms of building and engineering a capital stack, this is a lot of advanced stuff, but our loan officers in our company can help to do this for you. So they're going to underwrite the base cash engine for whatever deal you're going to be doing, whether you're buying a business or whether you're going to be using this information to buy real estate. They're going to underwrite the base cash engine. They're going to size the senior debt appropriately. A lot of the times in real estate, that's going to be at 80% LTV, where senior debt's going to cap out. It seems to be like where, in most cases, it makes sense for real estate transactions to price senior debt. And then they're going to backfill it with any mezzanine or junior debt where they see it as being possible. They're going to make sure to match those maturities as well, whereas, if you're going to be buying a rental property, that's something totally different than if you're doing a fix and flip. Maybe it makes sense to have a line of credit where your introductory period runs out in 18 months. You know that your loan officer is going to know that you'll be out of that project in about 6 months, so you have another 12-month period to refinance out of that property. Once it's stabilized, you can pay off that line of credit at that ARV and have any additional cash flow. We're wrapping up here, just some main takeaways. Equity is the most expensive form of money because it buys you upside, profit share, and control, but you're the first to absorb any losses. Senior debt is the cheapest form of money because it has the strongest claim, it has the first lien, but it also has the lowest interest rate. As you move down the capital stack from senior debt towards equity, capital gets progressively more expensive. And engineering good capital stacks is pretty much, it's like there's a balance, an art and a science to hitting the lowest feasible or achieving the lowest feasible weighted average cost of capital without sacrificing durability. And finally, probably the most important concept discussed here is how leverage amplifies equity returns, but only when the cash engine supports it through stress, not just in the base case. So I'm sure you noticed it, but combining working capital and DSCR loans to scale is what this capital stack is about, right? Your DSCR loan is going to be your senior debt, your working capital is your junior debt, and that's going to amplify your return on equity or cash on cash. So, how do you combine DSCR and working capital to scale a portfolio? Well, there are two different engines of capital. DSCR loans are asset-based. They're going to be your senior debt. They're going to be cheaper in most cases than working capital, and they're tied directly to the property or the asset's cash flow. Now, they're directly underwritten on the income coverage or the DSCR of how that property can service the debt repayment obligations that come from the DSCR loan. They're going to be longer term, they're going to be lower interest, and they're going to be best for acquiring and holding assets. Working capital is going to be a form of junior debt, closer to mezzanine debt. Honestly, it's always unsecured. It's going to be shorter term. It's pretty much never collateralized. Like I said, it's unsecured, and it's underwritten based on personal or business credit profile. It's more flexible, it's faster to fund, but it's a higher cost of capital. It's better for liquidity, it's better for down payment assistance, it's good for renovations, or if you're a business owner, it's good for marketing spend, and it's good for bridging gaps in cost. One is a long-term foundation, DSCR, and the other one is an accelerant, that's working capital. The reason why combining them works is because working capital fills the gaps that DSCR won't cover. DSCR loans want stabilized cash flows, but investors oftentimes need capital up front for down payments, rehab, or seasoning before DSCR financing is available. Working capital can provide that runway. DSCR loans also multiply working capital's impact. Once properties and projects are stabilized using working capital loan debt, then maybe DSCR loans refinance or recapitalize the asset. In most cases, that's what our most successful clients are doing. So that allows the operator to pay down working capital facilities and recycle them into the next acquisition, which creates a flywheel, and that's what allows you to scale. So you use working capital to access properties, access new deals, renovate projects, and control assets, and then you transition into DSCR for longer term takeout financing. You then recycle your working capital back into the next deal, and you're off. You have your wheel spinning and you're rolling. That's the flywheel in practice, but you can also utilize them just in the very vanilla way that we explain capital stack, where you take senior debt, you backfill a purchase price with as much senior debt as possible, you fill it with some mezzanine debt which has a higher interest rate, and you use that to reduce your down payment. That's going to get you a higher cash on cash return. That's another way to combine them. But just to see it in practice one more time, you use working capital to cover your down payment, closing costs, or renovations. Your property gets stabilized. You get a baseline for what your NOI is going to be. And then you transition the property into a DSCR loan with a lower rate, longer terms, better leverage, and you pay off or reduce your working capital exposure. You take those working capital lines of credit or term loans, and then you repeat. You keep going. You deploy them again into the next acquisition or value-add project. Over time, investors and operators can control more properties while maintaining cash flow discipline just by financing themselves properly. That's the DNA of our company. That's what we set out to do, and that's what we're doing and enjoy to do. So I think at this point, I don't have to drill home any more strategic advantages. Hopefully everything is coming together, but just to rehash everything one more time, you get accelerated growth, you get risk diversification, capital efficiency, and scaling. So we covered a lot, but I wanted to end on this slide because I think it is the most important. If you master this concept and understand how much each form of debt will cost and what the cost of capital can be in a transaction, hopefully at some point you don't need our loan officers to structure debt for you, and you can go out and do this yourself. It's going to allow you to change your life and buy as much real estate as you want. So we've talked about DSCR loans. What is a DSCR loan? What documents are required for approval? How to get pre-qualified? What to expect from that process? We talked about our DSCR loan credit boxes, our DSCR loans in particular, the types of properties that we can finance, rates and fees. We've talked about working capital. We've talked about how we originate working capital, what documents are needed for approval in that process, how to get started there. It's going to be with a senior capital advisor. You're going to have to prove your eligibility. We have to review your investment thesis, and then CPI sheets, processors, the whole 9 yards there. And we finished off with this concept of the capital stack, capital structure, and how to combine DSCR loans and working capital loans to scale. Hopefully you enjoyed this portion of the curriculum. Best of luck.